All right, guys, it's Tuesday. NVIDIA is up minorly today, but yesterday it started the day basically at 403, and it's currently at 443. At one point today, it was over 450. So NVIDIA is clearly the hype stock of 2023. Before it was electric vehicles, now it's AI. Before electric vehicles, it was cannabis maybe. What was it before?
Cannabis mixed in there with the hydrogen cars. That was a big push.
Oh, I don't remember that.
Solar panels.
Either way, that's the hype that's going on right now. You know what we think about hype. We tend to avoid it. Guys, we're going to go over NVIDIA here. We're going to go over some of the high-level metrics of the company. We're going to go over some bull and bear cases, some analyst estimates. Of course, we're going to cover our 8-pillar process. And then we're going to use our assumptions about the future to figure out the most important thing that you're probably looking for, which is what price to pay for NVIDIA today. Okay? Now, we're going to do all of this. Our videos involve things for beginners, advanced investors, everything in between. So follow the entire video, watch the whole thing. You'll learn something no matter where you are in the process. So guys, let's go over NVIDIA. NVIDIA, market cap, over $1 trillion. I remember when $1 trillion was a lot of money in the stock market. Now it's like, oh, you have an idea? Cool, it's $1 trillion. Now here's the metric that scares me the most about NVIDIA. Price to sales ratio. This is when you take the market cap of the company and divide it by the revenue over the last year, 42.5. So let's put this in perspective, because those of you out there who are like looking at this going, what the hell does that mean? Let's go to a company like Microsoft, which we actually think is overpriced. We've done videos in the past about it. It's selling for 11 times price to sales ratio. Okay. All right. What about Apple? Apple is the darling of Wall Street, the stock that can't go down. 7.3 times price to sales ratio. All right.
What about Tesla?
What about Tesla? Tesla, one of the most overpriced companies in history, 7.86 times. Oh boy. What about the Googly Moogly? The Goog, 5.76 times. All right. So we have a really interesting bear case on NVIDIA when it comes to the price to sales ratio. And we'll get to that in just a few seconds. But let me go over a couple more things about NVIDIA. First off, I love this gross margin, 56%. This is big numbers right here, Mo.
That's huge.
That means for every extra dollar they sell today, they'll put 56 cents of that, 56% of it, to their bottom line before taxes. With a bottom line margin of the last 5 years of 27% and last year of 18.5%, there's some piddly dividend yield of $400 million. Sick.
Why bother?
That's terrible. Now, 5-year average free cash flow and last year's free cash flow, this kind of surprises me. They're pretty much the same thing. For a company that's supposed to be like killing it, how is their 5-year average free cash flow the same as their 1-year free cash flow?
Now, this is a good thing to point out, though, for a company that's supposedly killing it. The story is killing it.
And by the way, I'm sure the
company is doing extremely well.
Yeah, and their revenue beat and things like that.
This is a good example of, you would say, oh, the stock price is up. What percent? 160% use this year?
And here's the interesting part. Oh, yeah. So
you would think that would follow.
Look at this. You're right. Year to date, it's up 210%. You're an idiot, Mo.
There you go.
How'd you not know it was 1 billion% more?
Damn it.
5-year return on invested capital is 18%. 1 year is 9.7. So those of you who don't understand what that is, that is the money that's invested in the business. What kind of return do they get on that money? How are they killing it? And the return on invested capital is actually almost half what it was the last 5 years. That kind of blows my mind. But either way, let's go look at the revenue by quarter. What did they do last quarter, Mo?
In what, revenue?
Yes.
Hold on 1 second.
What are you giggling about?
My chair is about to fall apart.
Is it?
Yeah.
How do we buy such crappy chairs? We spent all this money on this great studio and then we don't have good chairs.
7.19 in the last quarter.
Well, no, I meant from their actual... they haven't reported July yet?
I don't think so. Let me go check.
So 7.19. But guys, here's the interesting part. What did they do last April? 8.29. So they're down. And yet the stock is up an insane amount in the last year. Okay. So let's go over some news and some bull and bear cases for the company. Mo, start us out with some good news. What are some bull cases for the company?
Okay. So a little technical here. The NVIDIA H100 Tensor Core GPU. That's being used. I don't think you need to know about that specifically, but that's being used with Microsoft's Azure Virtual Machine series. So that's, I think, the big way to look at it as, okay, now they're incorporated with Microsoft Azure. That's great.
Okay,
that's
got it.
As of June of 2023, NVIDIA held 80% of the AI chip market.
Wow. which is supposed to grow 37.4% compounded annual growth rate through 2030.
Now I think to myself, there's no way that's sustainable.
Really?
Think about the competition that's going to come in there and take
Yeah, but
that
Mo, remember
market share.
Intel, I mean, you're right, but Intel held 90% of the chip market for a long time. Long time. We're talking about like decades.
Yeah.
It very well could be. And it's really, it's all about first to market and who's got the rep now for a great AI. It's them.
It's them. Yeah.
And they make a great graphics card chip. They really do dominate their industry. But guys, I want you to remember, we're here as investors. We're trying to separate the stock from the company. The company can be an absolutely amazing company, but the stock price could be crap. In fact, the stock price, the valuation could be so bad because of what an amazing company it is. Because everybody out there sees the stock going up and says, I got to get in on it because the story is great. But as our friend, Professor Aswaf says, a story without numbers is a fairy tale. And a number without a story is a spreadsheet. So we got to remember, we don't want to have a fairy tale here. We want to be the smart people out there who say, wait a second, this is awesome, but I can't just pay whatever price for awesome. Okay, let's go to some bear cases on NVIDIA. Okay. Is it possible that we even have bear cases on this company?
3 major customers, Amazon, Meta, and Google, all making their own version of NVIDIA's A100 chip. Amazon has already been in talks with AMD to start using their chips in their Amazons for the new GPUs.
Does Amazon... What do they not want to do?
They want to do everything. They really do. They just want to throw a bunch of you-know-what at the wall, and whatever sticks, great.
Yeah, great. More power to them.
Now,
give us this bear case having to do with price to sales, guys. This is a very interesting stat that our researcher, Dalton, came up with, who's actually in studio today.
Yep.
But we're going to talk about this amazing stat.
So this is from Siegel and Schwartz Research 2022. Stocks that sell at a greater than 25 price to sales return an average of
negative 23% over the next 5 years.
Yep.
Is that annualized or overall?
Overall.
Guys, and it makes sense. Think about it this way. The more you pay for something, the less return you're going to make.
Yeah.
But then again, guys, I was saying Tesla's overpriced much longer ago than NVIDIA. And Tesla's blown through my values. Even when I said they're overpriced, they've blown through those values. So yeah, it's possible. This stock could keep going up. The business gets better, and the stock never goes down until the business justifies today's price. But even look at Tesla. They're down over 40% from their all-time high, even though the numbers have gotten better since hitting that high. Over the long period of time.
You tend to see with hype.
Yes. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. In the short run, whatever's popular is going to go up. Whatever's not popular is going to go down. In the long run, the fundamentals of the business are what's going to drive the value. As long as you pay a reasonable price, you're going to do very well if the business does very well. But if you pay nosebleed prices, and dare I say that NVIDIA is overpriced, guys, if you're in the comments, please tell me how stupid I am. I'd love to hear it. If you agree with me, please tell me that you agree with me. Doesn't matter to me. I want to get the engagement going because I could very well be wrong about NVIDIA. But if I'm wrong about NVIDIA, it's because they did something well beyond what they're even thinking they're going to do. Because these valuations are insurmountable unless they do something well above and beyond what they think they're going to do. And if you're the person that's betting on that, it's going to be a hard process for investing for the rest of your life because you can't always bet on companies doing better than expected because they rarely do. All right? So let's check out the 8 pillars on NVIDIA. All right. So not a big deal, Mo. Shares outstanding are up slightly. Not a big deal. I don't blame them. I'd be printing shares like I was the federal government right here.
I would be printing more shares than they are.
I 100% would be. I'd be like, oh, you guys are all crackheads that want my crack? There you go. Here's more shares. Who wants more shares? Oh, Grandma Betty, who's sitting in a nursing home, who's all of a sudden heard her kids talking about NVIDIA. There you go. There you go. More and more shares. Now, guys, remember, if you're part of our community, you get our software, you can customize your pillars up to 12 pillars and 4 quadrillion different versions. But back to our pillars, 209 times 5-year earnings.
Not bad. 216
times 5-year free cash flow. Oh boy, we are late. I just feel like we're late in the market cycle, and to justify these valuations is going to be very difficult. The hardest one is Amazon and Tesla, because I've been saying Amazon and Tesla have been overpriced for 10 years almost on Amazon, like 8 years. And it has just gone straight up. And now their value is way higher than when I first said they were. The value I come up with is way higher than I first said they were overpriced. Yeah. They killed it into a raging bull market. Same thing with Tesla. But we'll see. I wouldn't be surprised if 10 years from now, all these companies are below the prices they're at today. All right, so analyst estimates. What do the ever so bullish analysts have to say? $3.33 last year in EPS, and they're expecting to make $8 this year. And wow, this is bizarre. Do you see this, Mo?
Yeah, the revenue is bizarre too. Are you looking at the 2027?
Yeah.
Yeah, look at the revenue.
We'll also look at 2026.
Oh, that is?
And then 2028.
The hell? Look at the revenue.
Yeah, this is odd. All right. So guys, there's a lot of growth potential, and it leaves us one decision to make. All right, what do we pay for the company, right? Mm-hmm. So guys, really quick, if you like our software, you like all the tools that are actually available in addition to all the things you've seen, you haven't even touched the software here. If you want access to 10,000 companies on your phone, on your computer, it'll change the way, it'll make life easier for you. You'll sleep better, understanding a process. We're here to teach a process. That's all we're trying to do, and this software makes it better. The EM community has thousands of investors who are like-minded who exchange messages every day. That's how we found Dalton. So guys, sign up at everythingmoney.com. We have a special running right now, 20% off. Go check it out. About $1 a day gets you access to all this software. So Mo, let's do a 10-year analysis. Let's give me some revenue growth. By the way, revenue is down 12.4%. 12.4% in the last year, but the stock's up $1 billion. Let's see, what is this stock up in the last year? 1 year, 132%. Oh, okay, cool.
That kind of sucks.
All right, so give me the revenue growth numbers you'd assume, Mo.
12, 16, and 20.
Wow. Go big or go home. What about profit margin?
24, 27, 30? What do you think?
Sure, I was going to go a little bit lower on the low side. Okay. I was going to go 22.
All right.
Let's go 26 and 30.
All right.
Free cash flow margin.
I would do the same thing.
Same thing.
Very similar.
So guys, what we're doing here is we're looking at the past and we're trying to figure out, okay, is the past going to be replicated? What does the past look like? How does it look like for the future? We can make any assumptions. We tend to go higher on our highest number because you want to see the extremes on the low and the high side. Like, okay, if this price comes out and the current stock price is well above even this value, it can give you a perspective on how overvalued the company is. And at the low side, if the stock is really low, like for example, Alibaba, we run the numbers on Alibaba and the stock price is 20% below our lowest numbers. So it tells us like, hey, this thing is really undervalued if we're right on this thing. So that's the point of using this. That's why Stock Analyzer tool is used thousands of times per day by our users. Literally over 2 million times since we started keeping track less than 2 years ago, a year and a half ago. Okay, so what about PE? Now keep in mind, guys, this PE makes me want to kill puppies. And keep in mind, I have 4 puppies. So the fact that I want to kill dogs after seeing this PE should just be very revealing. The way we look at it is we think you should start at 15 because that's a market average and go higher with revenue growth and ROIC and moat. And I think NVIDIA has all 3. They have revenue growth potential, they have a good ROIC historically, and they have the moat in this computer chip, in this graphics chip market. Wouldn't you say?
Yeah, that's true.
So you go up from 15 when those things are good, down when those things are bad.
Yep.
So Mo, give me your PE here.
I did 16, 20, and 24.
It's exactly what I was thinking about, Mo.
Cool.
Guys, I want to keep in mind, we're going super high here for a reason. We want to see, is this price even attainable on our best of assumptions? Now, finally, our desired return. This is basically our margin of safety, guys. What margin of safety you want? The lower the assumptions, the less return you need because you've already been conservative. But as you go higher in your assumptions, you need a higher desired return, and that gives you that margin of safety that everyone talks about. Just like a bridge. When you build a bridge that needs to hold 10,000 pounds, you build the bridge to hold 20,000 pounds. You don't hold it for 10,000 pounds because there's no margin of safety there. Same thing here with your investments. We want you to have margin of safety. Mo, hit me straight.
I did 10, 12.5, and 15%.
So I would have done a little bit different, but let's stick this one. I would have done 11, 13, and 16. I would have gone a little bit higher on the high side. I think these are just so absurd, Mo. I mean, this is so high. This is like literally every pot. We're talking about growth rate, the same as the last 10 years for the next 10 years. We're talking about profit margin, almost 20% higher than the last 10 years.
AI hits on every cylinder, basically.
Okay.
You know?
So guys, I'm going to hit analyze. Now keep in mind, several numbers are going to pop up. We've got 1 minute left in this video. Stay for the entire video. And don't forget to check out everythingmoney.com for 20% off on this amazing software that you can use every single day. Boom.
Yes, yeah. That's funny.
$66 on the low side, $150 on the high side, $100 in the middle. If you buy it at today's value, today's price, and the lowest assumptions occur, you're going to lose 11% a year. Middle assumptions occur, you're going to lose 4%. If the best of best assumptions occur, you'll make 2.1%. Guys, thank you very much for your time. Talk to you later.